Welcome to the Scale Up Valley podcast, where I bring the best founders, CEOs, and investors to help you scale a business from 1 million to 1 trillion. Today's guest is a very special one. His name is John Warrillow, the founder of the Value Builder System, host of the Build to Sell radio podcast, and author of the best-selling books Build to Sell, Creating a Business That Can Thrive Without You, The Automatic Customer, Creating a Subscription Business in Any Industry, and The Art of Selling Your Business with Strategies and Secret Acts for Exiting on Top. John, welcome to the show.
Thanks for having me. It's good to be here.
Yeah, and you are calling from Toronto in Canada, where I have been very recently, and I will be back in the first week of October.
There you go. Beautiful time of year, beautiful colors. Stay away in December, January, February, but in October, it's a beautiful place to be. Let's do a house swap. How about I come to your place in Portugal in January, and you can come to my place in Toronto in January? Sound good?
I'm not sure if my wife will be very happy with that, but yeah, we can talk. Just 1 year. I would be happy, to be honest. Yeah. I think the difficult one, it's easy, right, to say, but that's true, by the way. Anyway, John, let us know a bit more for the ones who didn't have the chance yet to get to know you, a bit of your story, your why, and why you became so passionate about helping other founders to create the option of selling their business or even preparing them for exit.
Yeah, it's probably because I screwed it up. When I used to own a quantitative market research firm, we worked with big customers and helped them understand small business. And our mantra at the time was kind of grow revenue, grow profit. That's how we thought about the business. And we were very proud of the fact that we had all these great clients. Bank of America, Microsoft were all clients of ours. And so we built it up to about roughly 6 million top line, call it $1.5 million on the bottom line. So it was profitable service business, classic kind of business. And I thought, I want to sell it. So I went to a guy, an M&A guy, Perry Miele is his name, in Toronto. And I said, what do you think it's worth? And I was sort of rubbing my hands together, waiting for the answer, hoping to be wowed. And he said, well, before I answer that question, let me ask a couple of questions of my own. He's sure. So he said, well, who does the research? And I said, well, I'm involved in doing some of the research, big clients, six-figure projects, I got to be involved. And he says, okay, well, who does the selling? And I'm like, well, it's like Microsoft, the Bank of America. I got to go to the meetings, right? Because and he said, well, John, there's nothing to sell. I can't sell your company. There's nothing here. It's worthless. And I said, well, what are you talking about? It's worthless. We've got $1.5 million in profit. Microsoft's a customer, Bank of America. What do you mean it's not worth anything? He's like, that means nothing without the company being able to run without you. If it's all dependent on you, it's just a job. And I felt, obviously, and a lot of entrepreneurs feel this way when they get told their baby is not quite as pretty as they thought it was, and their business is not as valuable as they thought it was. And it was like being punched in the stomach. And, I went on over time to take Perry's advice. We put a subscription program in place. We got me out of doing the selling. Ultimately, it was acquired by a publicly traded company, Gartner Group, based in the U.S., New York Stock Exchange listed company. So it had a happy ending, but it was a very tumultuous time. And I've sort of dedicated the rest of my life to helping other entrepreneurs understand what drives the value of their company. And so that's what we do at Value Builders. What I do at Build to Sell. Yeah, that's my story.
Yeah. And you were an operator, right? So nowadays you keep building also your own company. And according to my stats, you were also able to start and exit 4 companies so far, right?
That's right. Yeah. My current operating company is called Value Builder. So we're 40 or 50 employees, SaaS company based in Toronto.
That sounds amazing. Would you like to just quickly give us an overview about the Value Builder company?
Yeah, Value Builder helps, the most famous product we have is called the Value Builder Report. And it is used to establish both an estimate of value for your company along with what it could be worth in the future. And all the businesses that go through Value Builder start there. And the reason they do that is because it's similar to, if you think about when you show up at a trainer in a gym, what's the first thing the trainer does when you first start an exercise program? They say, hey, let's do an assessment. Let's see how your body fat percentage, let's see how many times you can do push-ups or whatever. And why do they do that? Well, number one, they do it to prescribe a plan going forward, but also they also do it so that you can see your progress as a client, right? So you can look back and go, wow, I could only do like 10 push-ups and now I can do 100. It increases and improves the client experience. And that's really what we do at Value Builder. So we have an assessment, business owners take it, and then we give them a prescription for how to improve. And then they can track it over time and see how their value is improving over time. We measure businesses on these 8 metrics that acquirers care about. So anyways, that's what we do.
Sounds amazing. And it's always great to be helping other founders with. Do you help other founders with the insights, with the book, with the thought leadership, with the podcast, or do you also or people are also able to reach out to you to be helped from you to prepare themselves to sell their companies?
Yeah, I don't do any consulting firsthand. So I'm focused really on building Value Builder. It's a full-time job. All of the intellectual property that we have, all the algorithm and all the analytics, we've had 70,000 users go through it now, 70,000 business owners. So all that is baked into the report. So no, I don't do one-on-one consulting, but I run this company that keeps me pretty busy.
Not very scalable as well, so it would go against your
advice. Kind of ironic. Hire me by the hour.
So that's a great answer that you just did. Consistency in the message and leading by example.
100%.
But I was just sharing the other day your podcast and your books to a founder and told me, I'm much more a fan of build to last instead of build to sell, right? And I thought, but you should check what Johnny is writing because I think it's always nice to build a business with the mindset of one day you would be an option to sell it, right? Even if you don't decide to sell it. So because in that sense, building a business that is sellable will make it, and according to your story and the why behind what you do today, it's really this. So if the company is not dependent on you, the company will be much more scalable, much more successful, and you will have options. So even if you are not thinking about selling your business, or it doesn't come to your mind that option at all, Build to Sell, that's a great guide. That's a great resource to read anyway.
100%. Yeah. Absolutely. The idea is that a company that's built to sell is one that is not dependent on you, is bulletproof. You've got all the options. You could sell, you could bring a private equity group in if you wanted, you could keep 100% of the equity and just be the chairperson and bring in a CEO. All those options are available to you if you structure it to sell. And to the point about build to last, I think there's 2 types of entrepreneurs. This is broadly speaking, a huge generalization. There are entrepreneurs who kind of think of their role as sort of a custodian of their company. They have these very grandiose sort of impressions of being the sort of patriarch of this business, and that one day they're going to pass it down to the management team or pass it down to their kids. And I just don't identify with that. I think a business is there to create freedom for you, the owner. Yes, you should have a vision and values and all that stuff. I'm not saying you shouldn't have that stuff, but business isn't a life sentence. Like, you don't have to own your business for the rest of your life. Your kids do not have to own your company after you're gone. I think that's akin to child abuse personally. You don't have to do those things. You can build a business, make it successful. And when it reaches a point where the value of the company, if you made it liquid, would fund the rest of your life, ask yourself, we call that the freedom point, by the way. Ask yourself, why do I want to go further? Now, maybe there's a reason. Maybe you want to solve world hunger. Maybe you want to, there's some bucket list thing you want to go do. But for most people who start a company, their goal is freedom, right? They want to do whatever they want, whenever they want to. That's their ultimate like core value as a human being.
Yeah.
And once you reach the point where your company could fund, the sale of your company could fund anything you want to go do forever, you have total and utter freedom. And the question that I would ask is, well, why would you continue to own your company? Too many examples of business owners who say, I just want to get to, and I realize this is the Scaling Up podcast, so forgive me for asking a challenging question to your listeners, but I think it begs the question, why do you want to grow your top line at the risk of your freedom? I'll give you an example. I just interviewed a lady on Built to Sell Radio who got to her company to $7 million in revenue, $3 million of EBITDA. She'd just gone through a bankruptcy before she started this company. So she had some kind of baggage coming into it. She reached the point of 7 million in revenue, 3 million in EBITDA. And
almost 50%.
Yeah, she wasn't satisfied. And she wanted to scale this business to, 15 different locations. Like, she had this big grand plan. And I said, okay, so what did you do next? I mean, you sort of come from the ashes where you didn't have anything, and now you built this company for $3 million in profit. And she said, well, I took on a mezzanine debt loan for $16 million, guaranteeing the $16 million loan with her shares in the company and a personal guarantee.
Wow.
And I just about fell off my chair because I said, you had reached financial security. You've come from bankruptcy. If you sold a company with $3 million of EBITDA, growing quickly, to your point, almost 50% profit margins, you're going to get 5, 7, 10 times EBITDA. So she was looking at, on the low end, $15, $20 million of cash for her company, which by any measure, unless you have some horrible lifestyle, is enough money to do whatever you want. She was 100% shareholder. And
especially if you invest it well. Yeah.
Instead, she said, no, we want to be $100 million company. And so she took on a giant risk, again, pledging all of her shares, all that $15 or $20 million of value she created, plus a personal guarantee, just because she wanted to be bigger. And I don't identify with that. Like, I think it's just so asinine. I think it's just insane to want to do that. I think the ultimate goal, I shouldn't say asinine, I just don't identify with it. Like, that's just not something that I would ever do or would ever recommend anybody do. I think once you built a company that could fund the rest of your life, if your goal is freedom, hit the bid, like, sell the company, take the cap, or at least do a majority recapitalization where, and I know your listeners are familiar with this, you can bring in private equity group, they'll take on, you'll be able to cash out 50, 60, 70% of your shares. You may want to roll some equity, but if you're relying on your company to fund the rest of your life, you reach the point where it could do that, hit the bid is my perspective.
That's really interesting. And even if you are willing to take that risk, at least be aware of the options that you have at this stage again, right? So this is really, really important. So don't be conditioned by what you are seeing in the magazines that nowadays the VC path is the path to go, right? And you need to build that 100 million that will be evaluated, the 10x revenue. It's the unicorn level, the $1 billion company. And we have a lot of VC backed companies here on the show, and I've supported multiple CEOs there. And that's a completely different game. So we need to grow 2x at least every single year to stay appealing. And we might turn an amazing business into a failure because it just doesn't follow the standards or the demands of the investors, and then you can't give back all the money that you raised because you have burned it anyway. And you can go back to have a lifestyle business. So there's not that option. But we are talking here a lot about founders who were able to bootstrap their businesses to 10 million, 20, 25% EBITDA, which would be amazing. 2 million, 2.5. According to you, kind of a 5x, it would be 10, 15 million.
Don't take the 5x to the bank. Her business happened to be a service business. There was no recurring revenue. So she would have gotten a lower multiple. If it was something with recurring revenue, SaaS company,
4x
would have gotten
3x,
much higher.
So, But anyway, that's what you're saying. It really helps the entrepreneur to have a lot of freedom and to be able to reinvest the money in other assets. Then there is the question of the purpose and what to do after the exits, the identity that is mixed with the business. That is, I think, the most difficult part is
100%. Yeah,
we are the business, right? So if we leave the business, we don't know who we are, right? Because
we just did a podcast with Rob Walling, who sold Drip for enough money that he didn't have to do anything for the rest of his life. He was 41 at the time, and Rob did a 2-year earnout. Again, didn't have to work. And it's one of those times where you have this sort of paradox of choice, right? You could do anything you want. And I think of it like Maslow's hierarchy of needs. Like once you get your foot on the first rung of Maslow's hierarchy of needs, where you're never going to worry about, food or shelter or the basic stuff. You're taken care of for life. It does pose the question, so what next? And if you think about back to grade 10 social studies, Maslow talked about moving up the hierarchy, right, to purpose and to think about what it is that your sort of life's mission is. And that's what Rob did. He went on a founder's retreat and figured out that for him, he loved to invest. And so he created a little kind of a micro investment group called Tiny Seed. Loves his podcast. I mean, he's reinvented himself successfully. I just did another interview, in fact, yesterday, a guy named Lloyd Lobo, who sold his company, and to your point, went through a terrible period of depression. He sold a private equity group. The private equity group they came to the realization that he was probably not the right guy to run the company after selling it. He put on a bunch of weight, drank too much, got sort of really bad for him. And it's not an uncommon story if you don't know what you're going to go do next. So I think it's important to have, we call them pull factors, but when you sell your company, you've got push and pull factors. Push factors is things that frustrate you, right? Like regulation, taxes, employees. Yeah. Pull factors are the things you want to go do next, right? And so what we would always encourage founders to do is get really clear on your pull factors. Specificity counts here, right? So I want to rent a house in the Algarve, and I want to learn how to windsurf. Great. Awesome.
Portugal.
Very specific, right? And then when you sell, you have those things to go to. Ryan Culp, another guy I interviewed, wanted to build a hobby farm, right? So he's happier than a pig in crap building his farm after selling his company. But that's because he had something that he was planning to go do. The worst is to sell for a truckload of money and then not have a plan, because that's just a recipe for a sense of loss, for sure.
Yeah. A lot of these things, and sorry to be so much on the why to sell, but I think it's really important for the ones who are listening us. And I know that our audience is very aggressive and very ambitious in general, according to what I've been sensing. And they are really on the way to how can we build an 100 million business. I know that nowadays people are much more aware. I want to build a large business, but also with a lot of profitability and cash generation. So it's not only burning and valuation. So they want something solid. But sometimes there is this kind of, in order to get, and we don't discuss here too much the starting up stuff, right? So get to 1.5 million, it's really survival mode. You are trying to find product market fit. You find product market fit, and then 1 to 5, you are 1 to 5 and 1 to 10, let's say, you are trying to find that predictability, that sustainability in terms of your revenue machine. How can you make it repeatable, scalable, profitable, right? So in that sense, typically when you have the machine in place, you have the leadership team, unless you hate your job as an executive because you are an innovator, a creator, an entrepreneur, and now you feel in a prison because you need to lead your weeklies, your monthlies, your quarterlies, have the one-on-ones with your CMO, with your CRO, with your CFO, and this is really boring to you. And maybe
I don't know anyone like I literally, do you know entrepreneurs like that? Like literally, I don't know virtually anyone that likes running a business north of $10 million. Like literally, I don't know anybody. Like I think of the world as 0 to 1, 1 to 100, like the Peter Thiel notion, right? There are guys and gals who love starting companies. They love it. They love the energy. They love the first couple million in revenue, the $3, $4, $5 million. When you move to like 10, 20, 30, $40 million, and there's like 100 employees, they can't stand it. They want to put a bullet in their head. They think the world, right? So that's when like you need to bring in a CEO who runs the company. As an entrepreneur, I know virtually like literally almost nobody that likes running a $10 million company as a founder. I know a ton of people who love running $10 million companies as a professional manager. They love alignment. They love doing employee reviews. They love getting the team together. They love having like product review meetings, right? Like all that stuff. It's like 100%, right? But they're not founders. They may be shareholders. They may be minority. They may have some options in the company. But the same guy or gal who started a company in their garage and sold the first company is almost never the guy who runs happily a $30 million company. I mean, just look at Rob Walling. I literally just interviewed Rob Walling. Built Drip to 10 employees, couple million revenue top line. Brought in a private, like an investor, and did a 2-year earnout. They took it from 10 to 100 employees. After 2 years, he just didn't want to go to work anymore. Like he was literally exhausted. Why? Because he's got a team of 8 engineers, 6 product managers, and like that's not what he wants to do. He wants to build product because he's an entrepreneur. Right. So that happened to him at 10 employees, right? He was happy from 0 to 10, right? million or 2 in revenue. But beyond that, no way. And I think I would challenge you to talk to the entrepreneurs who started, not inherited their business, not bought their business or had it passed down to them from their mother or father, but literally started from the garage. And I bet you that virtually none of them want to be the chief operating officer of their company. In other words, running the weekly management meeting, doing all the reviews, like none of them. I think they want to put a bullet in their head. That's my 2 cents. I challenge you to think that way. But again, there are lots of people that want to take a company from 10 to $100 million. They're just not they're not founders. They're not entrepreneurs. They are professional managers. There's a difference, a huge difference. It's a totally different headspace. And virtually none of the founders I know would be any good at running a $30 million company. Equally, none of the $30 million company operators I know would know how to start anything out of their garage. They need funding. They need millions of dollars of investment because that's what they need to structure their life. They're totally different human beings. They're like oil and water, black and white. Like you couldn't think of a different headspace than a founder versus a professional manager. Yeah, it's my 2 cents.
No, I fully agree, and it completely aligns with my experience so far. So in the beginning of my career coaching CEOs and leadership teams, I tried to make the CEO or the founder become a CEO, or what I call the CEO 2.0, the CEO 3.0 for the different stages of growth of the company. And I quickly realized that I'm not in the business of changing people, especially if the founder CEO doesn't want to be that person. You are right. So it's maybe 1% or 2% who are really willing to go through that transformation, but the majority really needs to build a very strong leadership team that will allow them to do what he or she likes. and maybe have a COO or second in command that would be almost doing the job of the CEO, or even if having more the courage, leave the ego aside, and being able to become more a chairman and an innovator, and have a CEO coming in, right?
I think that's right. I think more like once that business reaches, call it, I mean, I think there's something around like 2 layers of management that happens 50, 60, 70 employees, where it's not just you've got 1 layer of managers in your company. When you've got 2 layers of managers, now you've got you as the CEO, call it, the most senior person, has now got to influence people as opposed to direct them.
Yeah,
that's where it gets really annoying. And I think most owners would prefer, I think most owners, if they reach the point, again, we're talking about 0.00001% of businesses ever reach 70 employees. Like, this is a huge, massive business relative to the average, right? Only 4% of businesses in North America ever reach $1 million in sales, let alone 10 million, right? It's like tiny fraction of a percentage that ever reached this point. So we're talking about a unicorn to begin with, or a very, very unique company. But once, if you're lucky enough and savvy enough to get a business that you started from your garage to 70 employees, I think it behooves you to either sell it, or at the very least become an investor, not a CEO. A CEO runs the business. They're making the decisions. They've got a management team rolling up to them. They've probably got a COO that's doing the operation. They're still running the company, and they're going to be frustrated. They're going to be probably bad at their job, frankly, when it reaches 2 layers of management. And it's at that stage where I would encourage a founder that reaches 70 employees to say, okay, I'm going to be an investor, right? I'm going to be the investor. I may be the majority shareholder. I may bring in a private equity group to help, balance out my kind of personal balance sheet, but I'm going to think of this as an investment, just like I would my home, my vacation property, the stocks I own in Google and Microsoft. Like, it's an investment. You're not the CEO. I think, again, there are very, very, very few people that want to found, like, start companies and be a CEO of a 70 employee company. Like, Bill Gates comes to mind. If you think you're Bill Gates, then fine. But most people are not that person, right? Most people do really well. Most people are like Rob Walling, right? Do really well, 0 to 10 employees. Not great when it's 100.
Yeah. And we get back to what I was trying to do. What is the exact timing that you should start building your company to be able to have the option to sell? And clearly, I think that we stated it, right? So 1 to 5, 5 to 10, those are typically, or 1 to 10, those are the stages where you already need to maybe have the company structure to be not dependent on you, because if not, it will not be able to keep growing, and also to have the option of selling it. So we need to do it anyway. That was the initial point that we're talking about 100%. In the beginning. Yeah. So even if you want to sell or not to sell, and
like most companies, most companies reach a plateau. A few $100,000 in revenue, maybe $1 million or $2 million if it's like a manufacturing business that has lots of expenses and so forth. But they reach a point where if they are the rainmaker for the company, the front person, the rainmaker, the business will stall, right? It just reaches a plateau. And most people reach that plateau, by the way, and they think, great, I got a lifestyle business. This is great. I've got $2 million in revenue. I can peel out $500,000 a year. I feel like I live like a king. All my expenses are paid for, the boat, the car, whatever. Like, great. Most people reach that point and they're totally happy, but they're never going to go beyond that because it's dependent on them. They can't take a great vacation. So to go from the 1 million, the $2 million revenue business, and make it into a $10 million business, you have to think like an investor as opposed to like a rainmaker. Does that make sense?
Yeah, absolutely. And making the point that I think for some founders, it takes some time to get there is, so what is my number, right? What is the freedom number? And typically, if it is kind of 5, 10, as you said, unless you have very exquisite flavors and the lifestyle, and you want to buy a 10 or 20 million dollar house and have amazing cars that all that, maybe you need to go to 100 million and be able to replicate that money. But I would say for the majority of people, 5 to 10 million would be a very interesting package to have some freedom and not be worried about working or being able to do what you like and still make money, because I think that that's funny as well. But having more purpose. So which means if it is 5, it's 1 million EBITDA typically if you are running in a good way your company, or let's say 2 million, and 2 million already gets you to 10 million pocket. So 1 to 2 million EBITDA, which would be 5 to 10 million revenue if it is 20% EBITDA, right? So that is the stage which typically will sign you the check, right? So that was the point that I was trying to make it clearly. Right?
Yeah, which is why, by the way, if you look at the ownership of companies below 10 million and above 10 million, it's totally different. So companies with less than $10 million in revenue are almost always founder owned, right? They haven't gone through a recapitalization yet, right? It's the owner who owns the majority of the shares. Maybe there's a COO who's got some options. Maybe they've got a partner, but it's founder owned. Once you reach $10 million in revenue and you look at the segment of companies with 10 to 100 million in revenue, it's virtually never founder owned anymore. Now, why is that? The reason is because they've reached the freedom point. Somewhere along the line, whether it happens at 8 million or 12 million, I'm talking about revenue, or 14 million, the founder wakes up one morning and says, holy shit, my entire net worth is in this company. Everything is at risk in this company. Maybe I've signed a personal guarantee on our debt. And they wake up and go, what am I doing? Yeah. I need to sell and lock in my freedom point. So that's why companies with 10 to 100 million are very rarely founder led and founder owned. Usually you've got the founder with a minority stake still, because the private equity company has come in to recapitalize the business. That's the vast majority. Are there rare examples where the founder is still a majority shareholder of an $80 million business? Sure, there are. Yep. But it's very rare. Much more likely to see a company with that reaches that point. Again, it's natural. You kind of wake up and you're like, I've been living like the poker player with all my chips, on black, everything in on this company since I started it. And when I started it, it wasn't that big a deal because it was worthless, right? My entire net worth was my home, maybe some shares in stocks, whatever. But as the company tips up in value, it goes from being 5% of your net worth to like 99.9% of your net worth. Right. And that's when you're like, wake up and go, oh my gosh, what happens if there's a global pandemic? What happens if there's a flood or a volcano that erupts, or I have an employee or a cyber attack, or all this stuff that happens to business owners? And they're like, what am I doing? And so that's why, again, when it reaches 5, 10, 15, 20 million in value, most owners cash out and they're done. They keep a slice because they want to participate, but they want that first rung on Maslow's hierarchy of needs, and they do not want to be pushed off that mountain. They want to make sure they lock in that, and they're not ever at risk of leaving that first rung of Maslow's hierarchy of needs.
Love it. So let's go to the methodology and to the framework and to the way you think about, driving value and preparing the business to be sold. So what do you think are the main points that we need, or the main issues that we need to take care in order to make the business sellable?
Yeah, I mean, there's kind of one thing that's easy to say and hard to do. And so the big thing that you need to do is make sure your company can thrive without you personally. Because if you think about the definition of selling your shares, it means you are effectively removing yourself, and an acquirer needs to understand how that business is going to operate without you. And again, that's sort of a glib answer, it's a very superficial answer. It's very easy to say, hard to do. The number one thing you can do to make that a reality and to convince an acquirer that it does not depend on you is to create recurring revenue. Recurring revenue and people get confused between reoccurring revenue and recurring revenue.
Right.
Reoccurring revenue is like a rash you get. It's reoccurring. You never know when it's going to come. So if your customers repurchase from you from time to time, that's reoccurring revenue. Right. When your customers buy on subscription and you swipe their credit card on the same day every single month, that's recurring revenue. And acquirers value both reoccurring revenue and recurring revenue, but they're going to place a much higher priority on recurring revenue, right? Because they're going to realize that once you leave, they're going to want to see a tail to the revenue. So that's probably number one. And number two is again, we measure folks on these 8 drivers, but recurring revenue is arguably the most important. The second one is what we call hub and spoke, and it pertains to how dependent the business is on you. The answer is systems. So obviously for a lot of owners, and again, I appreciate a lot of your listeners are beyond this point, but for a lot of business owners, the kind of core aspects of their business, the secret sauce, how the sausage gets made is still in their head. Right. And there's a little bit of osmosis people learn from following the founder around the shop floor or the office, and they kind of get it, but it's not written down anywhere. And so that's a big component, is to create systems people can follow. Ideally, technology can follow, as opposed to everything being in the head of the owner.
The SOPs, right?
Standard operating procedures. We created a product called VidGuide, and the reason we created it was to help owners create standard operating procedures inside their company. Yeah. But that's another major driving force. A third one is something called the Switzerland structure, where the country of Switzerland is interesting. It's obviously has a checkered history, but one of the things to know about Switzerland is, at least the last time I looked at it, on a per capita basis, Swiss are the richest people in the world. Now, why is that? How have they become that way? Well, one of the ways they become so rich is being Switzerland. In other words, neutral to any of the world wars, right? So they kind of have taken this stance that we're not going to get involved. They didn't join the EU. You don't use the euro, et cetera. And we gave the name the Switzerland structure so that CEOs could have sort of a vision of what it means to have to be truly independent. And so there's 3 parts of the Switzerland structure score. Mm-hmm. It's your dependence on any key employee, any key supplier, or any key customer. And so what you want is independence of those 3 groups, right? So you don't want any customer representing more than 10% of your revenue. You don't want to be heavily dependent on a key employee. Nor do you want to be heavily dependent on a key supplier who could change the terms of the deal, raise their price, make supply a difficult issue, et cetera. So those are the 3 things that you want to make sure you've got independence of: key employee, supplier, or customer.
Love it. So very, very important point. And so now imagine that I was able to get and achieve all those points, and we would need to check another 4 or 5 of the 8. Yeah, which is a great hook to go read the book that I really recommend. And I say, okay, but I didn't have any interest from any investor to buy my business. So how do I create that demand? How do I make myself visible for a potential acquisition?
Partnerships. What you want to do is approach. So first of all, figure out who your natural strategic acquirers are. We have a tool called the Shortlist Builder, but effectively what you're doing is trying to figure out who would have some sort of strategic thesis, some sort of investment thesis to buy our company, right? And you can figure that out. And once you've got a short list of, say, between 30 and 50 companies that would have a strategic reason to buy your business, try to forge partnerships. And partnerships don't have to be with the CEO. You don't have to create a CEO to CEO partnership. What you can do is approach the middle management of the company and daisy chain your way up to a more senior person. I got the strategy, or one of the people that comes to mind when I think about the strategies is a woman named Stephanie Breedlove. She built a great company. They did payroll for parents who have a nanny to pay. And when she looked out in the universe and said, like, who should buy this company, it was quick that she identified care.com. Care.com is like, it's a website where you can get a babysitter. Like you can plug in your zip code or your area code, and it will give you babysitters in your local, au pairs in your local market, 5-star rated, et cetera. She realized that because she did a payroll for parents who have a nanny to pay, it was like a peanut butter and chocolate kind of relationship. Care should have acquired Breedlove's company. And so she approached care.com in the middle management ranks. She said, hey, let me just develop some content for the parents that you work on, how to successfully set up payroll for a nanny. And so she started contributing content to care.com's blog. Well, the marketing manager loved what Stephanie was doing, introduced her to the director of marketing. The director of marketing thought, oh, we should have a deeper partnership, introduced her to the CMO. The CMO thought, man, this is such a perfect marriage, introduced her to the CEO. The CEO identified the business as a natural candidate for acquisition, bought the business. It was a $9 million business, bought it for $46 million. So like an unbelievable outcome for Stephanie. But it started with just a basic partnership at a marketing manager level.
Because, of course, what you are saying is an acquirer who has a strategic reason to buy the company, who is be able to extract more value out of the company through the acquisition, will be able to pay a higher multiple to someone who is just doing a old co, and this might be a profitable business in the portfolio, but maybe will not add too much value in terms of creating any advantage for the group of companies or for the strategy of the company. So there, I only will acquire if I have a good price. So my multiple will go down, right? So it seems a great business. It would be nice for my mix, but it's not my priority, right? If I don't have the right price, I will not go aggressively try to acquire, because I see that I can turn that business from 5 to 10 million, or it will make my other businesses much more valuable by adding that business to the mix, right?
Yeah, that's 100% right. You're referring to a strategic acquisition compared to a financial acquisition.
Perfect. Thank you.
Yeah, strategic acquisition is where they have some sort of strategic asset. In the case of care.com, they had 7 million subscribers. So think about this, 7 million parents who have a nanny to pay. Breedlove had taken 25 years to build her company of 9 million in revenue. So if 1% of care.com's 7 million subscribers buy payroll from Stephanie, that's 70,000 customers. That's a business overnight 7 times the size of Stephanie's business that's taken her 25 years to build. Right. If 2% of 7 million people bought her payroll, that's 140,000 customers. Again, Stephanie had 10,000 customers at the time of the acquisition. So it would be like 14 times the size. So that's called the strategic acquisition, where the company acquiring the business has a tremendous economic incentive. Another good example, Jay Steinfeld, guy I interviewed on Built to Sell Radio, he built blinds.com. Blinds.com was the #1 purveyor of blinds, window coverings in the United States. And so Home Depot looked at this, and at the time, Home Depot had, call it 90 billion of revenue. They had 2 problems. Number 1, they were not #1 in the blinds category, and they wanted to be. Number 2, though, is that they couldn't get more people to buy on homedepot.com. They staffed everyone through these physical bricks and mortar stores. And of course, when you've got bricks and mortar stores, you got employees, you got insurance, you got real estate, there's a lot of expenses there. And so they realized that if they could move more of their revenue online, it was a huge profit bump for them. Again, if you take 10% of your 90 billion in revenue and you move it online, you're talking about hundreds of millions of dollars of saved costs. And so when they looked at blinds.com, they saw 2 benefits to buying the business. Number 1, they could immediately become the #1 window coverings company in the United States. But the second benefit was that Jay had figured out how to sell complicated products that needed to be installed on a website, because blinds.com, 100% of Jay's revenue came from people who bought online. And so he'd figured out the secret sauce of getting people who have sort of something to install that needs to be measured and they got to pick the color. It's so complicated, right? He'd figured out the secret sauce of doing that on a website. And so Home Depot bought blinds.com because they're like, if we can instill what Jay knows about selling blinds and we can actually graft that across $80 billion of revenue, that's a great acquisition for us. And that's why Home Depot bought blinds.com.
Yeah. So I think that it helps for entrepreneurs to think that it's the same exercise that we do with the customer, right? So we need to put ourselves in the shoes of the acquirer and understand, okay, I'm buying this business and I need to be able to have a huge advantage or a plan to grow this business. So it doesn't matter the past, and using your words in previous podcasts that I had the opportunity to hear, it's much more a game for the future. So typically entrepreneur will say, look, I made a huge sacrifice to get where I am. I made this, and that, and the business is fantastic. And the new owner is thinking, okay, how do I build the business to the next stage? Because my journey is starting now, right? So your journey is ending here, but mine is starting here. So if I'm not able to deliver any value, this is not a good business for me.
You're picking up on one of the biggest mistakes I think founders make when they want to go sell their company, is they're all a rearview mirror. They're all like, look at what I've accomplished. We've got 8 million in revenue. We've got $2 million of EBITDA. We've got this customer, this customer, this customer. Look at the management team I've created. Look at all the awards we've won. Look at our great locations, right? This is all rearview mirror stuff. It makes them proud, pumping their chest, thinking, great, this is awesome stuff, right? What you're forgetting, though, is the acquirer is going to start their journey as the new owner of your company. So while you may be super proud to have gotten it to 8 million and $2 million of EBITDA, they want to know how they're going to get it to 80 million. That's what they're caring. And the fact that you have a great brand, that you've won awards, that you've got good location, all this is great fodder that maybe indicates that there may be a potential to in the future grow. But never forget, what they're buying is your future stream of profit, right? They're buying your future stream of profit, not your past profit. They want your future stream of profit. So the more you can convince them that, yeah, you got to 8, but with their help, you can get to 80. That's when you start to get premium valuations for your business. They're buying your future, not your past. The past is just some vague kernel breadcrumb to suggest what you might do in the future. But your job is to convince them of the future, not what you've done in the past.
Yeah. And we are 4 minutes away of closing the show, and you are always invited to come back, join it. There is so much to cover, and I spend a lot of time on the why, on the timing. I think it's really important. It's a huge reflection, and what you will do after, right? Which is also, that is really important to prepare. So we didn't discuss too much the how to get there. But anyway, when we are discussing the art of scaling, it's a lot of this. There's something that I also heard you saying that I loved, which is you need to delegate the doing and then to delegate the selling. And we know that when we are scaling up, the delegating, creating that revenue machine, especially if the founder is sales oriented or has a sales background, and we have still founder sales in the business, this is really, really difficult to create that mechanism and that machine, let's say, that is repeatable, predictable, and profitable. But we have discussed this several times. Anything that I should ask you that is really important for the ones who are listening us, and that you'd like to wrap up with before I will not have time to go through all my last questions on the show, but
yeah, no, I think if I can leave your listeners with one idea that maybe summarizes a lot of stuff we've talked about today. And I've been overly dogmatic and argumentative just to hopefully make an entertaining conversation on some level, I hope. But
absolutely, I love it.
In a more sober sort of voice, I would just encourage founders to consider the idea that their biggest job as the owner and founder of a business is to be that of a parent, not a CEO. And what do I mean by that? I mean that if you think about your own life, Mike, do you have kids? Do you have kids?
Sorry, we're asking, not yet.
Okay. When you have them, it's transformational, but you will come to realize, I think, that your biggest aspiration for your kids is not that they become the next president of the United States, or they're a world famous pianist or whatever. They're just happy and they're independent and they can succeed on their own terms in the world, right? It becomes like the ultimate aspiration for most parents, that they have raised kids that can succeed in the world.
Yeah.
And I would just encourage founders to think of their role as the parent of their business, meaning your biggest objective should be to create a business that can one day thrive without you. That's the ultimate. Is a business that can thrive without you. You've given birth in the world. You've created life, and it will go on forever without you if it's not dependent on you. And that's a built to sell company, one that does not depend on you for its survival. It's the most important job as a parent. And I think instead of focusing on hitting the next EBITDA goal, hitting the next revenue goal, if you start to think, no, you know what? Actually, what I'm trying to do is build a business that can thrive without me. You start to make different decisions. I think that's the ultimate role of a founder.
And we always close the show in that way. So with advice to your younger self, and I assume it's very similar to what you just said, right? So you just answered to that. So that's a great way of wrapping up. John, thanks so much for making the time. I really appreciate it, and congrats for what you are doing. And thanks so much for joining us today.
My pleasure.
And to our community, thanks for being there. We keep bringing you the best of the best to make your life a little bit easier as you scale up your company. See you soon, and keep scaling.